Hey, what's up guys? This is Abir, and in today's video we will be talking about the top 5 best stocks if you want to invest in dividend stocks for 2020, and what do I think about these 5 stocks in long term, and why do I think that these stocks will help you gain substantial income in coming months and days and maybe years as well. Another thing that I would like to mention here is that in this video, as a part of stock search or company search, I'll also show you how you can do your research on the side as well, just to be on a safe side. That how do you want to evaluate a company, what do you think is the fair price of a company, and what is the easiest way to basically map a company in your portfolio, with what percentage you want to allocate your assets to. So I don't want to make it really complex like a lot of other people do. So that's what we are trying to avoid here. I'll give you just one simple way. With this, you will be able to evaluate the right price of the company and when you want to come in with your assets and you want to buy in, and when do you want to sell out if you want to. So without further ado, let's get into it. So yeah, if you see this screen right now, this has Disney stock. So this is my number one pick here. I currently have not invested in Disney stock, but I'm planning to in future. And why, I will tell you all the reasons why I want to invest in Disney stock and what it can do to your portfolio. So the best part of searching through Google is when you search a stock on Google. Let's say you are looking for Disney stock just like me. So you search Google, and then there is a tab which states financials. So financials, when you click on financials, it basically takes you to another Google page which has past 4 quarters of records, including all the main things that you should be looking for. Obviously, any company, when it releases its quarterly report, income report, revenue report, they do include everything in it, but the one that you will be seeing in Google on the first page under financials tab is the one that you should go for. So this is the number one resource, and the number 2 resource, as I mentioned, I'll discuss those, is Yahoo. Yahoo.com is the one resource. Basically yahoo.finance.com. It's a parent company of many other companies, but that one company basically gives you all the information that you need to research the company that you want to invest in. So with Disney under our search, let's see what we are looking for here. So number 1 is the revenue. Obviously you want the company to be producing positive revenue, so it's not losing money. Instead, it is a company that is making you money. So with dividend stocks, the best thing is if the revenues aren't positive, and if the payout ratio is less than less than 50, I would say. People agree, or some people do not agree with this number, but usually under 50 is a good payout ratio. So anyway, revenue is the first thing here, and with this view you are able to see last 4 quarters, basically last 4 quarters that makes up a year, with all the statuses and all the information that you need. So we have revenue listed here, which is positive $18 billion revenue, which is close to 21% year over year increase. Then we have net income. Net income is $460 million for Disney, which is 91% drop from last year. So year over years mean The last year, what was the number for net income, what was the number for revenue for the same quarter. So March 2020 is what we are seeing here. So year over year, the stats that you are seeing on the right side of this screen is the last year comparison to last year. So again, diluted EPS, the net profit margin, and everything you see here. The two big advantages is the net income with Disney stock, and the number two is cash on hand. So cash on hand is $14.3 billion, which means they have increased 42% of cash on hand from last year's month of March. So this is big. Then if you see the earning calls, basically earnings call is nothing but a quarterly report when a company publishes it, like did that company made some money, or did that company lose some money. So based on that, it basically gives you earnings per share. People who are sitting in Wall Street basically are called analysts. So those analysts estimate an earnings per share, and if a company beats that, then for Disney, as you can see here, it has beaten the prediction, which was very less, compared to 2.9% increase in revenue in quarter two of 2020. So this is all you need to see. And then again, if you the last thing that is missing from this Google financials is the Yahoo report, which states the payout ratio. Payout ratio should be one of your concerns if you are trying to look into the market, and the reason being that you don't want to invest in a company which is paying more than 50 or 60 or even 70% of their earnings in the dividends. So this is something that you want to avoid. Don't go for a company which is paying more than 70% in dividends. I try to avoid any company that is paying more than 50%. But let's see what's the payout ratio for Disney here. So you see earnings per share 2.97, and ex dividend rate and dividend forward is what we have for when is the dividend is going to get paid and everything. And then payout ratio, I think it was in the other tab. Give me 1 second. So yeah, so in the dividend section you will be able to see payout ratio for Disney. It is close to 76%. As I said, like, it is a company that is valued very at very decent price. So if a company's price is going to get higher, then obviously the payout ratio will go lower. So once this payout ratio comes down to close to 60% or even less than that, then I will be able to value it as a really good investment. But I have an eye on it, and I'm considering it since the cash on hand is a big positive number with Disney. So this is one company that we wanted to talk about. My second pick here is Johnson & Johnson. Johnson & Johnson has a track record of close to 58 years of paying dividend. So if you want to invest in a blue chip stock company, which is basically going to pay for the rest of your life, most likely, then Johnson & Johnson is the one to go with. We currently see the price is sitting around $142. And then in the financial section here, the March 2020 report, everything you look here is in green. So cash on hand is $15.53 $2.3 billion, which is 5.4% increase. $20.69 billion revenue. Net income is 5.8, and net profit margin is 28%, which is a lot compared to some other companies that I will feature in this video, and I have featured in my previous videos as well. So big positive, everything green, and then if you see here, except just one time, Johnson & Johnson beat every time the revenue prediction, and basically the earnings per share prediction from the analysts. So going into Yahoo Finance and seeing the income statement, let's go to the tab again where it says the statistics, and under statistics you'll be able to see the dividends that it pays. So currently at current price of $142 a share, the payout ratio is 59.28%, which is less than 60, as I said, and then the dividend yield is close to it hovers between 2.7 to 2.9. If the price of the share tanks, then you will most likely be able to get more for what you spend. So your dividend yield will be little more than that. But average, if you go with the average, it is 2.7% dividend yield, and then profitability is profit margin is 20%, which is a big plus as well, with over $83 billion in revenue. This company is something that you should really consider. This is basically considered as one of the blue chip companies and one of the safe play. So the dividend yield is not too much, but at the same time it is a safe stock to play with. Then my third stock here today is Apple stock. So obviously Apple is a well-known company. For the past few years it has been paying dividends as well. Dividend yield hover about 1%. The current price is $338. Then in current year, in March 2020, the revenue was over $58 billion, so which was again an increase, so it's in green. Net income falls a little bit, and with all the tech stocks especially, you will see the revenue going up but net income coming down. So how does it make sense is whatever the company is earning, the revenue it is generating, it is spending more in research and development, it is spending more in acquiring other businesses, it is more spending in basically investing back in the business, and that is why the net income seems very less than the revenue. So revenue is whatever they make profit, and then net income is what they are left with after paying everything else. So that's why it is a little low number compared to the revenue. Then cash on hand, again, big blue chip company with over $1.3 trillion of assets. Apple has over $40 billion in cash in hand. So in case of anything happens, you are most likely to see still the dividends coming in from companies like Apple. Then last 4 quarters or 1 year previously, all the analysts, Apple has beaten all the analysts' expectations, and every time it has beaten with good numbers. So last quarter it has beaten the expectation with over 6.72%. So which is a big number. So if you go to the Apple stock, and we'll go to the statistics to see the information about dividends, dividend yield. So the dividend yield roughly hovers around 1%, as I said. If you look at the previous dividend yield, it was 1.58 5-year average, because the price of the Apple stock is growing so fast. It is a growth stock, and people have invested so much in Apple that the price has gone out of the roof, and that is why the dividend yield has come down. What it means is basically it doesn't mean that you won't be making money. You will still be making a lot of money in dividends, but at the same time, the value of the share that you are holding will appreciate as well. So you're gonna make more money from the value as well as from the dividend. So this is one thing to consider, and obviously it is a blue chip company with over 1.3 trillion dollars in assets. So you can't be going wrong with Apple as well. My fourth company is Dominion Energy. Dominion Energy, basically the company, the headquarters is in Richmond, Virginia, which is the capital of Virginia as well. Since I'm in Virginia, I've been a user of Dominion Energy. They are the ones providing different neighborhood, different location, different cities actually, with the power, with the electricity or the power. So it's a very stable stock. You won't be seeing too much fluctuation in it. The value of the stock pretty much stays the same or grows very steadily with time, but at the same time it's a very solid stock. So especially if you see the numbers here, so in this year, in month of March, the numbers were out. Year over year, revenue has increased over 16.5%, which is a big number. Again, net income has decreased a little bit, but no worries with the company this size. And the cash on hand, again, it has gone over 1.1 billion dollars. And if you see here, cash on hand is 182% increase from last year. So you can imagine how much cash do they carry, and whenever they want to get rid of the loans, or they want to give some incentives to their customers, they can with 1.2 billion dollars as a cash in hand. Another big advantage of having a company with over $1 billion in cash is that you're gonna get paid for your dividends, most likely. Like, there is 99% chance that you're gonna get paid with this kind of cash in hand if a company has, just this quarter, obviously you see it has missed the earnings per share, but overall this is a solid share, and you won't be going wrong with this. If you see the analyst information, how do they think this company is going to perform in coming years? Long term, it's in green. Mid-term, it's in green. Short term, it's in red, which means that it's a good buy for now. Let's go to the statistics and see how much dividends they are paying. So with its current price, it is paying close to 4.48% of the dividend. So it's a big number. If you want to have something solid in your portfolio, and don't forget to invest in this. I'm doing it. It's not a suggestion, but this is what I'm doing it. So that's why I'm saying that if you want to invest, that this is something that you should consider investing in. Payout ratio seems a little bit higher, 172%, but again, that has to do with the current the crisis that we have gone through. But in the coming months or years, this is very consistently paying dividend company. So do consider Dominion Energy as well. My last stock, it comes from home improvement section, and Lowe's. Lowe's is my fifth and the last stock that I wanted to feature in this video. Currently trading at $126 with capital, with its headquarters in North Carolina. The company has gained close to $20 billion in revenue in the first quarter of this year, which was close to 11% increase from the last year. And then everything you see here is in green. Net change in cash is also $5.24 billion, which is 112% increase. Cash on hand is close to $6 billion. So you can't go wrong. The only downside with this is when we go to the Yahoo Finance, and I'll show you the dividend yields that you will be making. But for now, if you see the company's earnings, this company is most likely to beat the market expectations and with good numbers. Again, Lowe's is kind of a stock where you'll see a lot of growth in it. So the price of the stock itself will go high, as well as the dividend appreciation. So if you see the dividend section of Lowe's, it is paying close to 1.6, 1.7 currently, yielding you that much dividend, which is, I know it's not a lot, but this dividend yield will going to get bigger and bigger, and I'm pretty positive that this yield will increase with time. The payout ratio is 37%, which is again little on the high side, but since it is a growth stock, the value of the stock will increase. The payout ratio will most likely to decrease from here. And lastly, if we talk about the business model of Lowe's, it is in home improvement. Most of the people in US and in North America overall don't tend to invest, buy stuff for home improvement from sites like Amazon or other websites. So this is one of the business which has still performed really well compared to other retail stores. So this is a really good stock to invest in. Currently, it is selling at a decent value, and I think the price appreciation will basically take the stock to newer heights. So this is it. Thank you guys for watching. I hope you guys like this video. If you haven't already subscribed and this video helped you understand something about stocks and dividend stocks as well, just make sure to hit the subscribe button, and don't forget to turn on the notification. That is it from this video. I hope I'll see you guys in my next video. Till then, take care of yourself and people around you. Goodbye.